Let me also get on board our next guest, another gentleman who's joining in, Sunil Subramaniam, market expert. Sunil, was this the push that markets were waiting for? Because we have fired up and how, especially on the Nifty Bank Index. We made a fresh high. It's almost a 700-point move, a 1.5% move on the Nifty Bank Index. We made a fresh 52-week high of 56,457. We were consolidating, and now look at the way the markets have also taken off, given the double bonanza that we have got in terms of CRR cut and a 50 basis point rate cut. Are we ready to, make a dash at, the previous highs on the Nifty as well? Because after being ranged, this is when we get out of this range of 24,500 to 25,100.
Well, yes. First of all, you said as market expecting, absolutely, market was not expecting. And I think that's the biggest thing, that market always reacts to surprises, negative or positive. And this has been probably the most huge positive surprise that you could have expected. The second, I think that while I shared the thoughts of the previous speaker in terms of the economics of the decision, what I liked was the clarity of thought that along with the rate cut, he's brought in the change in stance. Why I'll tell you this is very important? Because if the stance had continued to be accommodative, it indicates a worry that he's doing everything he can, but there's still worry. But by changing the stance, he has been very clear that he's front loading, he's taking a risk. There's a leap of faith by the RBI governor, because not only this, the 100 basis point CRR cut. So clearly he's focused on what? So if you see, go back to this, the fiscal policy and monetary policy are today in coordination. They gave 100,000 crores of giveaway to the middle class, and now he's making sure that the banks pass on the rate cut through the CRR cut. 2.5 lakh crores of money released for the banks, right? Now, if they don't pass it on, it goes to their profits. But I think that fiscal and this going hand in hand is that he's taking the leap of faith. And I think that this will be the thing which will take the economy out from where it's stuck at the 6.5 level, and in an uncertain time help us push towards 7. While the RBI has not revised the growth projection yet, it's still at 6.5, but this will cascade into a much higher growth rates once we have a BTA and everything signed. So I think that I would compliment the RBI governor. It's a 10 on 10 policy that you take a risk, right? In a positive way before anybody expects it, because that will now create a multiplier effect in the economy. Hats off to the RBI governor. I think I've been a bull on banking for quite some time on your show, you're aware, right? And I think this is the payback moment for all the earlier thought processes.
But Sunil, with increased lending and so much money mobilized for lending, what happens to bank margins? That's my first question. And secondly, we've seen earnings trickle in from banks, and there were one-offs, of course, in terms of higher MFI exposure. Banks got impacted, but otherwise bank performance has been fairly good in the fourth quarter. So how would you play the rate cutting cycle, via the private banks or the public sector banks?
So my preference would still be the private banks, and for the reason being that you talked about the net interest margin pressures, right? Now, obviously, banks would go all out in a competing scenario to reduce rates on lending products to boost the volumes, right? So you would then say, oh, then margins will get affected. But there are two things here, right? There's 2.6 lakh crore of CRR cut, which is going to aid the profitability of banks. So your NIM margin pressure, whatever you face on the new loans, would get compensated by 2.5 lakh crore of additional profits, because you're not placing that much money at 0% with the Reserve Bank, right? That's number one. Second aspect is that if you look at it, the incremental loans to existing loan book share is very, very small. So in the existing loan book, private banks have got auto loans and personal loans, which are fixed rate loans. So there's no impact on the existing lending book in terms of the interest rates. It's only the fresh loans getting added, which will be at lower rates, and they don't need to reduce the deposit rates so much. But if you looked at it, already the banks have cut deposit rates in the previous quarter itself. And that's why if you see, their deposits were actually surplus. So you see the end of March numbers, bank deposit growth rate was far higher than the lending growth rate, and banks were placing their surplus with mutual funds in liquid schemes and overnight schemes. So banks are flush with money. The governor also mentioned about not only the banks being flush with money because 9.5 lakh crores of liquidity is already provided, but he also mentioned about the quality of the banks. He said the banks are in very good position. So to that extent, right, the NIM pressure on new loans is going to be there, will be compensated by the CRR cut and the fact that existing loan rates may not come down so fast. So I think overall the volume growth will more than make up in a EPS number because it's priced into quantity. So I don't think that you will expect to see EPSs continue to grow. Though new loans, there could be margins being less, but I think that's worth it because ultimately, if you want to kickstart the economy, and that's where, the way the RBI governors approach, if I may make one more point, is that he is talking about strengthening what India is strong at, which is domestic demand. So he is, instead of looking at it as a defense against the international tariff scenario, he's saying, let's go and play our domestic the strongest we can. So if domestic demand is going to grow even stronger, that's the best counter tariff related uncertainty on the export side. So I think that the doors are very clear for a massive rate cut on lending products at the personal loans, auto loans, real estate loans side. And hopefully with the 1 crore of giveaway in the budget for the middle class, we should see a strong revival of urban demand. And since that's the case, it's the private sector banks which will lead that because they'll be very fast to act, turnaround will be very fast, and public sector banks will gain over a period of time when industrial lending picks up. But the initial phase of it, private sector banks are going to walk away with the bulk of the new loan sourcing that's going to happen.
But what about NBFCs? NBFC sector will also directly benefit, right, because of lower, cost of funds and, potentially improved credit demand. So within the NBFC space, Sunil, would you look at the larger names?
Yeah, absolutely. Why I'm saying this is they need to have bargaining power because the CRR cut is only for the banks. So how much NBFCs borrow from the private sector, they borrow from market, but they also borrow from banks. So to the extent that what extent banks pass on this lending to NBFCs versus directly lending to themselves, there's an issue. So I would weigh on the larger NBFCs because they have bargaining power. And so the larger NBFCs will be the better ones to bet in because ultimately they are dependent on bank lending as a part of their liability book to lend to that. But otherwise in turnaround time and the reach, the last mile reach, clearly the bigger NBFCs are way ahead of even the banks. So yes, I would place my bets on the larger NBFCs who are in the retail space.
What changes when it comes to the FPI flows? Because, the rate differential, the yield rate differential, has significantly narrowed. And of course, US yields are going up for, higher US debt. That's another trigger for US bond yields going up. But for us, it's narrowed quite significantly. But given the fact the kind of measures RBI has taken, to boost lending, to boost growth, etc., do you think that would, compel the FIIs to in fact take a relook at their portfolios and perhaps not pay so much attention to the narrowing gap? Because nobody would want to miss on the India story, right? Because that's still the fastest growing emerging economy.
No, actually speaking, this narrowing gap, first of all, let me state that this is a big positive for FIs to come in. Okay. Now, let me address the last point that you raised first before I speak about that. The narrowing gap is actually positive for FIs to come in. And let me explain why. Because the currency movement of two countries is a function of the difference in the interest rates. Now, this narrowing gap means in the future, the depreciation pressure on the rupee will be much less because now the fundamental reason for depreciation is the difference in interest rates, which is only 1.75 today. And as the previous speaker was saying, if there's even a 25 basis points cut in India's long-term yield, that differential comes down to 1.5, which means the rupee depreciation will be only, the long-term average rupee depreciation is 3%, against which is only 1.5. So an FII investing today in a scenario where he had already baked in a 3% in the normal course rupee depreciation, already has seen it come to 175. If it goes further down to 150, any loss on account of rupee depreciation becomes that much less. So there's actually a fresh impetus to put more money into India now because relative to other emerging economies, Indian economy's depreciation is going to be less. That's the point. So for me, the interest rate differential narrowing is a positive for FIs to come in. So that's one. Second, the reason why this will be a big positive for FIs is because 35% of the large cap index or the MSCI index is banks. And as I said, a 2.5 lakh crore savings to banks because they're saving on 0% CRR is a huge positive for banks. And if you have the lending also picking up, right? Even passive funds allocation to India should step up because of the sheer weightage. So there would be a big flow into India passives from abroad. So to me, that banking sector is a big bellwether for an FI to take a call in India, other than IT, of course. So that's again another positive. The third is that this is giving the Indian economy domestic resilience, because this rate cut, as the RBI governor mentioned, he's supporting this 1D, the domestic demand. And if that picks up, that's the best support you can have against tariff uncertainties. So I think that their whole look about the Indian economy, and for them, India is a stock. They will reprice this stock very quickly. And I think this, along with any positive news on the BTA coming forward, right, will be a huge positive, and it should open the doors for a lot of even short-term FIIs now look positively at India. So I expect that that will come in and itself help the currency, because the flows itself will come and give a support to the Indian currency. So overall, I think this is a big positive for FII flows, which I hopefully over the next few weeks you should see a huge inflows coming in.
I just want to talk to you about the real estate space. Home loan rates will fall, quite rapidly, so to say. But here on, do you expect affordable housing to, get a significant boost? Because luxury realty, as it is, has been doing well.
I think so, and I'll tell you why. Because of all the rate, what RBI governor has done clearly, has told the banks in no uncertain terms that I want you to pass it on. That's the purpose of the CRR cut, the front loading of the rate cut. So I think that if banks, who are the primary lenders to the affordable housing segment, apart from housing loan companies, of course, is that the leverage impact of a small reduction in EMI on the size of house you can buy. And if you consider the 100,000 crores of middle class giveaway, I think it will go a long way in terms of boosting this affordable housing segment, right? Because they are very rate sensitive there. Because the rich people, right, who you mentioned about luxury homes, for them the rates are a tax efficiency, for that they borrow. Otherwise, it's bulk of this is their own money. But at the middle class segment, right, this, as the cities are becoming more unaffordable and people are forced to go outside to the outskirts to buy even a 2-bedroom flat, a small difference in the rates can make a huge difference in terms of their affordability. So I think ultimately that's the big takeaway that one should expect from this. Whether it translates, we'll wait and see. But I think the RBI governor has clearly done everything that he can. And I would expect that the affordable housing segment, and one more segment, the entry-level car and two-wheeler motorcycle segment. These are the two places where the EMI reduction will make a huge impact on an aspirational purchase. So lots of people who weren't thinking of buying a house, weren't thinking of buying a two-wheeler, now would probably come into the bracket of wanting to do that. So I do think that, of course, now the ball rests in the banks and the housing finance companies court on how far they go and actually drop the EMIs, drop the lending rates. So I think if they do act as per the RBI governor's expectation, there should be a significant boost to affordable housing and to entry-level automobiles.